Watch video 4 on Chapter 1, Investment Landscape from the Workbook for NISM Series VA, Mutual Fund Distributors Certification Examination, and review the multiple choice questions and answers. 1. What does inflation risk refer to? A. Risk of prices falling. B. Risk of interest rates falling. C. Erosion of purchasing power. D. Increase in purchasing power. Answer: C. Erosion of purchasing power. 2. If inflation is 8% PA, how much would 10,000 rupees today be worth after 10 years? A. Rupees 14,693. B. Rupees 21,589. C. Rupees 46,610. D. Rupees 100,627. Answer: B. Rupees 21,589. 3. To maintain purchasing power, investment returns should be A. Less than inflation, B. Equal to inflation, C. Higher than inflation, D. Unaffected by inflation. Answer: C. Higher than inflation. 4. What is the term for investment returns that are not adjusted for inflation? A. Real rate of return, B. Nominal rate of return, C. Actual rate of return, D. Fixed rate of return. Answer: B. Nominal rate of return. 5. What happens if your investment returns are lower than inflation? A. Your purchasing power decreases, B. Your purchasing power increases, C. Your investment remains unaffected, D. Your investment grows faster than inflation. Answer: A. Your purchasing power decreases. 6. Liquidity risk refers to A. The inability to sell an asset quickly, B. The risk of prices falling, C. The risk of inflation rising, D. The risk of interest rates rising. Answer: A. The inability to sell an asset quickly. 7. Which investment option typically has low liquidity? A. Equity shares, B. Bank deposits, C. Real estate, D. Government bonds. Answer: C. Real estate. 8. In case of premature withdrawal of a fixed deposit, what is likely to happen? A. Higher returns, B. No impact on returns, C. Deduction in interest earned, D. Increase in interest earned. Answer: C. Deduction in interest earned. 9. Which of the following is an example of low liquidity investment? A. Equity shares, B. Public Provident Fund, PPF, C. Mutual funds, D. Savings account. Answer: B. Public Provident Fund, PPF. 10. What is credit risk? A. Risk that the borrower will repay in full, B. Risk that the borrower will delay or default on payment, C. Risk that inflation will rise, D. Risk of market prices fluctuating. Answer: B. Risk that the borrower will delay or default on payment. 11. Which type of borrower poses the highest credit risk? A. Government bonds, B. Stable companies, C. Small, new companies, D. Market leaders. Answer: C. Small, new companies. 12. What type of bond usually offers the lowest interest rates? A. Government bonds, B. Corporate bonds, C. Junk bonds, D. Debentures. Answer: A. Government bonds. 13. Which of the following is not a type of risk discussed? A. Credit risk, B. Liquidity risk, C. Price risk, D. Regulatory risk. Answer: D. Regulatory risk. 14. Which risk can be reduced by diversifying investments across different securities? A. Market-wide risk, B. Firm-specific risk, C. Interest rate risk, D. Inflation risk. Answer: B. Firm-specific risk. 15. What is the relationship between interest rates and bond prices? A. Direct, B. Inverse, C. No relationship, D. Random. Answer: B. Inverse. 16. If interest rates rise, the prices of existing bonds, A. Increase, B. Decrease, C. Stay the same, D. Fluctuate randomly. Answer: B. Decrease. 17. What is market risk? A. Risk of a company failing. B. Risk of all stocks in a market falling due to external factors. C. Risk of a single stock failing. D. Risk of inflation rising. Answer: B. Risk of all stocks in a market falling due to external factors. 18. What is price risk? A. Risk of inflation eroding returns. B. Risk that a specific company's stock price will fall. C. Risk of market-wide decline. D. Risk that interest rates will rise. Answer: B. Risk that a specific company's stock price will fall. 19. What is a firm-specific risk? A. Risk that impacts only one company. B. Risk that impacts the entire market. C. Risk related to inflation. D. Risk that affects interest rates. Answer: A. Risk that impacts only one company. 20. What is an example of an industry-specific risk? A. A government policy change affecting all companies in an industry. B. Market-wide stock decline. C. Increase in inflation. D. Interest rate changes. Answer: A. A government policy change affecting all companies in an industry. 21. Which investment is most affected by interest rate risk? A. Equity shares. B. Real estate. C. Bonds. D. Commodities. Answer: C. Bonds. 22. Which of the following is an example of market risk? A. A company's sales declining. B. A new product overtaking a company's old product. C. All stock prices falling due to war fears. D. A government bond defaulting. Answer: C. All stock prices falling due to war fears. 23. Interest rate risk affects which type of investment the most? A. Stocks. B. Real estate. C. Bonds. D. Commodities. Answer: C. Bonds. 24. What happens to bond prices when interest rates decrease? A. Prices increase. B. Prices decrease. C. Prices remain the same. D. Prices fluctuate randomly. Answer: A. Prices increase. 25. If an investor sells a bond before maturity in a rising interest rate environment, they will A. Get a premium price. B. Get a discounted price. C. Get the same price as face value. D. Get no price at all. Answer: B. Get a discounted price. 26. What is a major cause of volatility in stock prices? A. Inflation rates. B. Interest rates. C. Changing opinions of buyers and sellers. D. Real estate prices. Answer: C. Changing opinions of buyers and sellers. 27. Which type of risk is market-wide and affects all securities? A. Firm-specific risk. B. Liquidity risk. C. Inflation risk. D. Market risk. Answer: D. Market risk. 28. Which risk is difficult to avoid, even with diversification? A. Credit risk. B. Market-wide risk. C. Firm-specific risk. D. Interest rate risk. Answer: B. Market-wide risk. 29. What happens to the value of an investment if the real rate of return is negative? A. Purchasing power increases. B. Purchasing power decreases. C. Investment grows at the same rate as inflation. D. Investment remains unchanged. Answer: B. Purchasing power decreases. 30. Which risk could lead to an inability to sell an asset quickly at its current market value? A. Credit risk. B. Liquidity risk. C. Interest rate risk. D. Inflation risk. Answer: B. Liquidity risk.